And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Two ETFs launched last week, one to address the still growing interest in crypto, the other a different business, buffered ETFs, let's call it. Let's talk to the principals of both of these new ETFs. David Botzett is the managing director and the head of equity product management and innovation at Schwab Asset Management. They launched a new fund last week, the Schwab Crypto Thematic ETF, symbol is STCE. It tracks an index of global exposure to companies that may benefit from development of cryptocurrencies and other digital assets. And Bruce Bond is the CEO of Innovator Capital Management. Last week, Innovator launched the Innovator Hedged Tesla strategy, which seeks to track the upside performance of Tesla to a cap with a maximum quarterly loss of 10% or so. We'll explain all that. It's a little tough. But, David, I want to start with you. Bitcoin's down about 50% this year, a Bitcoin ETF. Who knows when that's going to happen? But several new crypto ETFs have launched, including yours. Why now, with Bitcoin down 50% this year?
You know, Bob, with the way Schwab Asset Management approaches our product development, we're not trying to time the market. So not providing an indication or our thoughts on if we're at a bottom or another place with Bitcoin and cryptocurrencies and digital assets. It's more about responding to customers asking for exposure in this space and delivering a product that will stand the test of time and provide that access to them. So that's really what drove us here. And it was happenstance that we got to a timing of a launch where crypto's where it's at today.
Yeah, you know, there must be something in the air. Horizon Kinetics launched a blockchain development ETF last week, an actively managed fund that invests in companies that benefit from digital assets. But I look at the main holdings here for the crypto thematic ETF. I see a lot of names that we know well in the crypto space. These are not Bitcoin, but companies, MicroStrategy, Marathon Digital. I see Riot Blockchain. I see Coinbase, Silvergate Capital, Robinhood, even Interactive Brokers. How is this particular thematic ETF different from other crypto thematic ETFs that are out there?
Yeah, I think we really look at our differentiation in two ways. One is on cost and one is on the index design. On the cost, we've launched the lowest cost crypto-related product in the marketplace at 30 basis points. The other is about the exposure and the index design. And you're right in that the top names in the index and ultimately fund holdings are much the same across those products. But as you get beyond the top 10, our approach of combining the human insight with AI and models to assess companies' exposure to the crypto theme we think is differentiated. So you see a name like NCR Corp, which owns the largest network of Bitcoin ATMs, or StoneX, which is a company that provides institutional investors trading of crypto as well as custody services. Those are names that are really differentiated in the space. We have other examples in Japan and Europe that are in the fund, and we think that over time that's a big differentiator for investors.
Yeah, I think the problem here is it's still tough to get pure plays in any of this. With any of these situations here, remember with pot ETFs, for example, a few years ago, that was impossible to get the kind of exposure people actually wanted. And when you wanted to do gaming years ago, you couldn't just say buy NVIDIA because NVIDIA had other products. And you're still limited by the amount of real pure plays that you have out there, aren't you? Isn't that's still an issue for you?
It is, you know, and I think, Bob, as we look at whether it be crypto, any other theme, or frankly, take it to another approach, when you think about sectors, you think about today's sector products and sector exposures. Well, generally speaking, you say, I want a technology exposure, but you know, think how broad that exposure is in technology. I think what we are doing with our approach in defining a thematic beta is a way to systematically assess a company. Sometimes it's a large exposure, sometimes it's smaller, that will change over time. We think that especially those smaller companies, as it has the potential to increase within their business, they may see a larger benefit over time.
You know, last week, I thought about you because I know we were going to have you on. I saw BlackRock announce that it was teaming up with Coinbase to offer Bitcoin to institutional clients. Now, right now, this seems to be only just Bitcoin, no other cryptocurrencies. But I'm wondering, that seemed fairly important to me. Are we seeing any broader acceptance of crypto? I mean, BlackRock wouldn't do this on a willy-nilly. I mean, what about Schwab clients? Are they asking for more crypto opportunities? And how do you handle something like that? It's still a very speculative investment.
It is a very speculative investment, but we are seeing certain segments of Schwab investors that are seeking to provide or seeking access to this asset category in their portfolios. So we're looking at ways in which we can do that. This is the first step in that. You know, will there be other ways? Potentially, but I think as part of that, we're also analyzing and thinking about what the regulatory environment looks like in the future. You know, you mentioned what happened with Coinbase and BlackRock. I do think that's a recognition that this market is maturing. You know, Bitcoin has been around for over a decade. And as it continues to mature and as other cryptocurrencies and digital assets continue to mature, I think we're going to see them be a larger part of our economic environment in the U.S. and globally.
Like I said, I don't think BlackRock would do something. They're cautious. They're like Charles Schwab. They can't just go chasing fads if they think they're going to blow up on them.
Right.
They have
They
their
didn't
own.
do that. Yeah.
Just like Schwab, they have reputational risk here
totally
too.
agree.
I want to turn to you. You've got a very interesting new product out as well. I've known you for many years, but this is a really interesting one.
Yeah.
You launched the Innovator Hedge Tesla strategy, which seeks to track the upside performance of Tesla to a cap. Now, explain how this works.
Okay.
It's not easy for investors to get their head around it. We do have a full screen, but just explain how it works.
Very simply, really the idea is a lot of people want to purchase Tesla. They want to be involved with Tesla, but they're worried about the volatility of Tesla, also the valuation of Tesla. You know, if Tesla was valued like Ford, people would lose 90% of their value right away. So we're saying for those people that want to get in, they want a long-term investment, this is how it works. You buy TSLH, hedge Tesla, you get basically 10% on the upside, and you have a 10% floor. Now, what a floor is, that's a max loss of 10%. So if Tesla goes down 20%, you lose 10%. If it goes down 50%, you lose 10%. And each quarter, that resets. So at the end of September, it will reset on the calendar quarter, each calendar quarter, and you get another, whatever the upside is. We don't know exactly what it would be. Right now, it's 9.23% when we just launched it. Each quarter will be in that range, and then you have a downside of max loss of 10%. For example, let me tell you how somebody could use it. I had a big appreciated position in Tesla, up 800 some odd % over the last several years. I decided to take my position, roll it out into this. And now I only have I have a max loss of 10% in this. Now, I'm not going to get as much upside, but we don't believe that Tesla's going to have that kind of upside it has in the past. It's a huge, think of it, it's not $1 trillion anymore, but it was one of 5 or 6 companies at $1 trillion. They only sell 1.5% of all the cars in the world. Yeah. Does that really make sense? Yeah. And what we're saying is, we're not so sure it does. We think a lot of people are concerned about it. There's a great way for you to stay with them. 2
points here. First, this is essentially a collar trade, it seems to me.
Yeah, similar.
There's an upside. Now, you're saying it was 9%, but the way I put it up there it was 10%. So if in a quarterly basis, if Tesla's up 12%, you're only going to get 10%
exactly
of the 12%.
Exactly. You're only going to get up to the cap, and then you give the rest up.
Right. And there's a downside protection here. So I think it's important to know you don't actually own Tesla shares. You own Tesla options and treasuries, right? And that's how you get this
That's
mix.
Exactly right. That's how we give that position to people so that they can, they can get exposure to Tesla, but without all the risk of Tesla.
Yeah. So the other thing people have a hard time getting their head around is this reset.
Sure.
And leverage and inverse for years, we keep telling people these things reset every day, and people can't understand and get their head around what a reset means. This is a quarterly reset.
Yeah.
So timing kind of makes a difference here, doesn't it?
It does. It does. I would encourage people to go to our website and see where it's at, because since we launched it, Tesla has moved up some. So you may only have about 5% left on the upside from here. But if you get in around the end of September, when it resets,
it's important for you to know when you're getting in, right?
It is.
You can't just say, I'm going to buy Tesla. It's going to be in the middle of, the quarter.
Well, you can, but it's important for you to know what your outcome. You can find out your outcome any day. If you go to innovatorsetfs.com, go to the website, look up Tesla. It'll tell you, well, you have this much upside left and you have this much downside. Right. And so you can see every day what your exposure is and what your opportunity is.
So this started, what was it, July 26th?
Yeah.
Right? And it resets at the end of September. Is that right?
It's a shorter period this first time because we're trying to get on the calendar quarter. So it was just 2 months really this first time.
Right, but my point, I'm sorry to keep repeating this, but I know people were going to get confused about this. It's really important to know when you're going in and buying it.
Yes.
Because if you're in the middle of the quarter and Tesla's already up 5%, you've capped really another 5% gain, essentially.
Well, so what has happened is Tesla is above the cap already, but the fund itself is only up about 4.5%. So you have another 5%. So let's say if Tesla doesn't move from where it is, the fund will, as the options expire, will go up to the cap.
Yeah. All right. I want to point out that Bruce has got some much broader products that are out there other than the Tesla one. I know we're dwelling on that. But last year you launched a broader buffer product, the Innovator Defined Wealth Shield. This is BALT, BALT is a symbol, and it tracks the return of the S&P 500 to a cap. Very similar. Here's a full screen explaining it, but Bruce, again, just walk people through what you're getting.
Yeah, so on BALT, what it is, it's meant to allow people to get into the S&P 500 with very little downside, but exposure to the upside. So the way to think about it is you have it's quarterly again, so each quarter it resets. And Bob, to your point about the reset, remember, you don't have to do anything at the reset. The fund automatically resets and gives you a new cap and a new buffer in this instance. So BALT is based on the S&P 500. It has a 20% buffer to the downside quarterly. So if the S&P goes down 21% during a quarter, you would lose 1%. Now, you get 2.5% of the upside quarterly. So it is very rare. Like if you look at first quarter this year, it didn't even go down. It was down like 15%, or second quarter actually. So you didn't even get into the 20% this year, how volatile the market was. Now, why would you buy this?
It's a pretty long-term put, a pretty far out put there.
Well, it's just a quarterly. Decline. It's quarterly, but it's a 20% decline. It's a buffer.
Yeah.
And so why would you buy this? Why would you use this? Well, the reason there's been so much interest is people that don't want to buy bonds. They know rates are going up. They're pretty sure they're going to lose money. They would rather link their low-risk money to the equity market with a 20% buffer against losses. So you aren't going to lose in that first 20%, and take this 2.5% or whatever the cap is on a quarterly basis. Remember,
so
it'd
but
be 10%
if you're up
over the year.
5% on the quarterly basis, if the S&P's up 5%, you're only going to get 2 points.
You only get 2.5.
Okay. So there's a little bit of a call here just above the market.
Exactly.
And a pretty big put way below.
Yeah, well, we have a put spread at the bottom. We buy a put and sell a put. And then we have to actually sell a call at the top. That's what gets you your cap to build the position.
Right.
It's a
so
zero cost.
It's all options. You own all options.
It's all options.
Yeah.
And it's a zero cost position for people. So a lot of people are saying, hey, I'm going to take maybe half or a quarter of my fixed income position and link that to the fixed income market, go for the 2.5% on the upside, link to the S&P 500 rather than just stay in the fixed income market.
You know, I know these buffered ETFs have gotten some assets, but they are difficult to understand. And the regulators have voiced alarm over these kinds of complex ETFs. Folks, I've talked about this on the air. We've had Gary Gensler, the SEC chairman, on. He warned earlier, he calls them complex products. They could pose risks even to sophisticated investors and can potentially create system-wide risks by operating in unanticipated ways when markets experience volatility or stress conditions. This is Gary Gensler. What do you say? Gensler is targeting, initially made comments on single stock ETFs, but this falls under what he calls these complex products that are difficult to explain.
This new ruling that came out, this new ruling that they came out, they asked questions for feedback. But remember, there were all kinds of ETFs, not even options-based or not even daily, that were kind of encompassed in this thing. I mean, he called a lot of ETFs, complex. And really, the important thing to remember, when I started selling ETFs back at PowerShares way back in 2002, 2003, nobody knew even what an ETF was. ETFs were considered complex. And just because it's new does not mean it's complex. Sometimes it takes time to understand what it is in order to understand how it works, because I would just tell you that the buffers bring tremendous value, risk control value for thousands of investors now and advisors. And it's a great tool in the marketplace. And I think FINRA is starting to realize that, and the SEC is starting to realize that. And so just because it's new does not mean it's complex. But you do need to do your, in investing, I say buyer beware. Make sure you understand what
David,
you're investing in.
I know you're talking specifically about crypto here, but there's something that Gensler has made the same point about crypto. He's had concerns about it. He's obviously pushing back against a Bitcoin ETF, and that's causing a lot of consternation in the Bitcoin community. But does Bruce have a point here? Just because it's new doesn't necessarily mean it's complex. I'm just wondering how you deal with this issue, because obviously you want to continue to do financial innovation, provide products that the clients want, your clients want. At the same time, what happens if this blows up and then all of a sudden we all have to stand around trying to explain why it blew up, and gee, was that a good idea to begin with? How do you find that balance?
Yeah, I think it is a tenuous balance at times. And Bruce and I have both been in the ETF market for a long, long time, longer than I would like to say. And it has been all about, I would say, two things. One is education. And that's education both for investors and our regulators. That's so important. One, for investors, making sure they are understanding the products that we are putting in market before they are going out and making that a part of their portfolios. The second on regulators is having that open dialogue. When they've got questions to learn, we can be a source for them to learn. The other part that goes into it for Schwab Asset Management is how do we test it internally ourselves? You know, we want to do a lot of due diligence, a lot of research, a lot of back testing to say, all right, in different market environments, before we bring a product, how is this going to perform? Where are the risks? What can we do to mitigate those risks, to put in place a product that is really sound structurally for design for investors' portfolios?
And you know, you look at MicroStrategy, or you look at Coinbase. I mean, these things have had absolutely wild price swings. We always bring up Bitcoin. It's like, well, that's not such a great store of value. The thing's down 2/3 in a year, and yet some of these underlying stocks that are associated with this, they've done the same thing. Some of the Cathie Wood stocks, not associated with crypto, have done absolutely wild things in the last year, where we sit around and say, well, okay, you knew it was speculative. You knew not many of them were making any money or no money or losing money. And then we had a rising interest rate environment. Duh. We know what happens historically.
That took care of it.
With this, David. So, when I bring this up, I'm very neutral on the price of Bitcoin, but I do point out that we've had the same wild swings in some of the pure play products, equity products that underlie these things.
Well, and speaking of complex too, remember, they can buy all these individual stocks out there that they don't understand a lot about. Being able to have that in a portfolio that's at least diversified for them, I think, is a benefit to a lot of investors.
Yeah. You were going to say something,
That's
David?
exactly right. No, I was going to say that's exactly right. So many investors will look and try to take that position through one or two stocks. And that just actually adds to the risks. When you can do that through a diversified basket, or as Bruce has done in providing some caps on upside and downside, that can be a little bit more controlled and measured way to get that exposure for investors that they're looking for.
You two guys have been in the ETF business a long time. I'm wondering if you have any observations of what we're seeing this year. Bruce and I were talking earlier, David, and the thing that's remarkable to me is in a year where there was really serious ups and downs in the market, overall, there are still inflows into equity ETFs. They tend to be still the plain vanilla broad ETFs, the S&P 500 type funds that still continue to get slow but steady inflows. Schwab was fairly late to the ETF game, and yet you've been remarkably successful in gathering assets, in a lot of it in simple, plain vanilla formats. I'm wondering, David, start with you. Do you see any overall trends in ETF that sort of stick out to you this year?
Yeah, I think there's a couple things that stand out to me. Bob, you mentioned it, broad-based equity exposure. It's happening in fixed income as well. And let me just pause on both of those for a moment. When you look at equity and that downside, I think what we saw was a lot of investors taking the opportunity after a significant equity bull market to reposition their portfolios. A lot of those investors likely coming from active strategies and moving into passive strategies where they had big gains that they didn't want to take that tax bite to move into lower cost options, and they were able to do that during that downturn with equities. Similarly, in fixed income, we've seen huge fixed income flows this year. And I think, again, it's repositioning of portfolios. As we saw that inflation trade take up and really to grab on the attention of investors, we saw a lot of flows into tips. As it seems like we may be, and you can debate on whether it's a hard or a soft landing, you're starting to see some of that repositioning in fixed income occurring as well, looking at how do I want to really position my portfolio from a credit standpoint or an interest rate standpoint, and getting very specific. And that's driving a lot of the fixed income ETF flows, because you can get a little bit more granular positioning than many mutual funds have historically provided.
I was really surprised, apropos of what David was saying about inflows into bond funds in July. You think, my heavens, rates are going up eventually. At least the Fed wants that to happen, and yet we're seeing
it's
inflows
been amazing to watch
bonds. Bond ETFs.
Huge amount of flows. And I think the reason it continues to grow, I know you're a big fan of Bogle, and the passive approach tends to continue to outperform the active approach. Even in this downturn, they say, well, wait till the downturn, we're going to outperform. And, time and time again, we just don't see that. And I think you couple that with, we are huge believers in the ETF structure, the chassis, to deliver, most of the performance to investors, as well as defer your gains through time. Those two things coming together are going to continue to drive flows in that direction. And I think, until we see the ETFs, the mutual funds really spin down quite a bit, you're going to continue to see that flow.
Yeah, I have to agree with that. One of the reasons I'm such a backer of the ETF structure, other than the obvious thing of tax efficiency, and originally it was for indexing largely, is just how innovative it's become. So you can pick up on whatever the new trend is. With pot ETFs and crypto eventually, and now you see more specialized product like single stock ETFs and buffered ETFs. And I may have differences of opinion with people about how good these are for the general investors or how safe they are, but the main thing is to keep promoting financial innovation and products that enable financial innovation. And we may argue about how much guardrails you ought to put around them for the investor, but there's no doubt that ETFs are one of the great financial products of the last 50 years. I think, one of the great innovations.
I think too, Bob, that the important thing is on complex products in this issue, it's very important not to shut down small firms who want to bring innovative products and to tell them and move them to the sideline. It's important to support them and realize they're new. We need to understand them. Are they doing something safe for investors? And let them go forward. Otherwise, this innovation that's so great, we'll start to lose that in time because people won't be able to bring new ideas because of the rules that are put around it.
David, I'll give you the last word. What else is out there in Schwab's toolbox? What else? What are you hearing from investors? Is there something out there on the horizon that you think the Schwab investors are looking for? What do you see?
I think it's getting to the heart of what Bruce and I are both talking about here is how do I continue to personalize my portfolio with unique exposures like the Schwab crypto thematic or a buffered ETF? And how do I continue to reduce the cost of my portfolios to help me build wealth in my portfolio? Because that's the one sure thing that can benefit a portfolio is reducing costs.
I was hoping he's going to say new pot ETFs or something like that. But I knew I wasn't expecting you to say that.
I don't think he'll be doing that one anytime soon.
See if I get a reaction out of him. Thanks, guys. I really appreciate it. That does it for this week's ETF Edge. My thanks to David and Bruce. And we've asked Bruce to stick around a bit and chat more on the growth of these complex ETFs and where they might be going for the ETF Edge podcast. That's coming right up. And remember, you can see all of our shows on our website, folks, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.